With housing hot, real estate has been booming, and that's both been in the traditional model and a new wave of cloud-based and software-centric real estate and brokerage models, including Fathom Holdings, which is up over the past year 300%, even after a 9% drop this morning. The chairman and CEO joins us. Josh Harley is with us this morning following the third report as a public company. Josh, welcome to the show.
Thank you so much for having me. I really appreciate it. I'm excited.
Thank you, Josh. I want you to walk us first through your model before we get into some of the earnings. As we've talked with some of the recent new types of brokerages, the kind of cloud-based, software-centric. How does that play into your business model?
Sure, I'd love to share. So like other real estate brokerages, Fathom is a full-service residential real estate brokerage. However, and I think this is key, we leverage an innovative platform as a service model. You talked about the cloud-based technology, which is powered by our proprietary cloud-based technology called IntelliAgent. So this tech platform, it allows us to operate virtually, which, by the way, was great when the pandemic hit, right? We didn't miss a beat, while a lot of our competitors are still trying to figure out how to operate virtually for the first time. So we can operate virtually while providing our agents with all of the major functions that they would otherwise get from traditional brick and mortar companies. And not only does it aid our agents, it also allows Fathom to really streamline and automate our operations, significantly reduce our costs and, of course, our personnel requirements, and also allows us to scale and expand the business without the excessive spending that usually accompanies growth. Ultimately, we believe that our technology platform, we believe it gives us a faster path to profitability, right? And that especially faster than most of our competitors who are still charging those large monthly fees and large commission splits to their agents. One of the unique things I do want to share about Fathom is that we offer a very small flat fee commission structure thanks to our technology to our agents, versus a large percentage split that a lot of our competitors charge their agents. And that means that realtors make more money simply by joining Fathom. And as you can imagine, this makes us highly attractive to agents. In fact, in 2020, we saw a greater than 37% growth in agent count, ending the year with nearly 5,500 agents. And I do want to add one more thing, that attracting more realtors to our low-cost model also means that we're attracting a higher number of home sales to our business, which allows us to capture potentially more business from the title business, as well as future mortgage and insurance business, which can allow us to significantly increase our revenue per transaction. So we're really excited about our future, and we're just getting started.
Josh, the point about the growth in agents, I want to talk about that as it boils down to the business model. Just to be clear, when you say that you're bringing in agents which can drive revenue further, you're talking about generally the ability to capture more real estate sales at the end of the day, right? Because we've talked with the CEO at EXP, for example, where they have a model where agents actually get paid by bringing on more agents. Do you have something similar to that, or is this purely housing sales that make the business money?
No, so we do and we don't. So we avoided that multi-level marketing aspect of the business, and we really focus more on just incentivizing agents through providing better service and better splits. At the end of the day, providing them the ability to make more money from their own transactions is hugely attractive. With that said, though, we do have incentive plans for agents referring other agents. In fact, right now, about 1/3 of our growth, our agent growth, is from our own agents referring other agents to the company.
Okay.
So we find that it's been very effective.
Josh, what I'm curious about in terms of the kind of agent-driven narrative that I'm hearing is, do you still have to have the housing at the end of the day and the square footage that gets sold to make the money, right? And is this about a baseline view that housing will continue the boom that it's in, or do you run into risk if there's any slowdown in housing to having a bunch of agents but too few properties to sell?
Yeah, so it's a loaded question. There's a lot to answer that one. So I will say this, is that, inventory is always a concern. One of the things that we're seeing, people bring up interest rates. I heard you in a previous segment talking about interest rates going up. I think as long as we stay below 4%, we're going to be pretty healthy. Interest rates aren't really what's, I believe, slowing down people buying. You're starting to see some reduction in apps as well. So there's a lot of people concerned about what's happening in housing. But a lot of it really comes down to the fact that right now, in every single home we sell, virtually every single home we sell, there's multiple offers, right? There's 5, 6, 10 offers on every single home we sell. And that really, I think, is what's causing a lot of the inventory decline because sellers are scared to list their home. If they sell their home, can they buy a home on the other side? And so I got to be honest, for us, interest rates going up a little bit is actually a positive. We need a little bit of a softening on the buyer side because right now, again, we got 5, 6, 7 buyers in every deal. Let's say a 10% decline, we still have 3 or 4 offers in every single deal. It's not a bad thing. We're still selling all the homes, but it gives sellers more confidence to be able to say, okay, I'm ready to list my home in the market because I feel like I can find something on the other end. So a little bit of softening on some aspects, I do believe will increase the inventory on the other side.
It's an interesting point.
I want to add something that I think is really key. Let's say, for argument's sake, that housing does decline. This is an area I think that Fathom really would shine. I think that for our model, if the market declines, let's say 20% for argument's sake, and I'm not by any means suggesting that's the case, but let's say it does. An agent moving from one of the larger traditional companies, just simply moving over to Fathom, even though they close 20% fewer homes, will make 8% more income. So my point to that is we'd actually benefit from that headwind, right? So if the market declined over time, agents will get fed up. So I need to make more money. And I think they'd start moving over to Fathom in much larger amounts. So we would actually benefit from, and by no means do I want another black swan event, but we would definitely benefit from a down market and we'd grow. And so while total home sales may be down, Fathom may be able to offset that by higher growth of agents and more sales. It's
an interesting point that I want to just keep exploring because for folks listening, and me too, we're wondering, wait a second, hold on, this is a brokerage company, their business is to sell homes. Why would it be good if the housing market would slow? Your point is from a competitive kind of market share aspect. If there's a little bit of a tighter market, then you'll have a greater value proposition for agents to come over and then capitalize whenever that market is strong. So that logic I can follow. From a stock perspective, from an investor's perspective, Josh, it seems like with the stock down today, investors are saying maybe it's time to start thinking profitability because you narrowed your loss, but you're still at a loss. So how is that happening when we've had such a big boom in housing?
Yeah, so first of all, we're newly public. We've been bootstrapping this business. A lot of people grow their business, they raise VC, they raise other equity. We bootstrap this business all the way through to going public. And so, we've a big part of those losses, by the way, I'll go back to, is due to the fact of going public, right? Especially since the fact we bootstrapped the business. But even that, so you talk about losses, we significantly improved our net loss from $4 million in 2019 down to $1.3 million in 2020. So we're improving that, and of course, increasing top line revenue and continue to have a positive impact on our bottom line. So we're very positive. We're very bullish for ourselves on the industry. Of course, I know I'm biased, but I'm very excited for what we're able to do. At the end of the day, we can't control what happens with stock. All we can do is put our heads down and work hard and focus. And if the market does come down, at some point, we'll get through it and the market comes back up. At that point, Fathom will be positioned even greater, even stronger than ever before. And so we'll be in a position to take advantage of any down. I don't anticipate it, I don't want it, but we will take advantage of it.
Josh, are you able to figure out right now what type of expectations for a timeline to profitability are reasonable given the current agent count, the dynamics that you see? I mean, it seems like there are expectations that you'll continue to take agents from competitors, but let's say it is static. Where does the profitability begin? When does the profitability begin?
So we're not making forward-looking statements. However, I can say that we're getting close.
Okay.
Right. You can see, dropping from, 4 million to 1.3 million, EBITDA from 2.3 to 381,000. We're moving in the right direction, and so we're very close. I can't say when we will be, but I think you'll be very surprised and pleasantly surprised to see how soon that is.
Okay, Josh, looking forward to continuing the conversation. Thanks for being here this morning.
My pleasure. Thank you for having me. Thanks
a lot. Josh Harley is the chairman and CEO at Fathom Holdings. Down 10% today after earnings, but has bounced now down only about 7%.